Before we begin, please remember that I am not a licensed financial advisor or insurance professional. This presentation is for informational and educational purposes only. The information provided is not intended to be a substitute for professional financial or legal advice. You should always consult with a qualified and licensed professional before making any decisions about your insurance coverage. Your personal situation is unique, and the information in this video may not be applicable to your specific circumstances. Imagine this for a second. You're driving home from work. Maybe you're stuck in a little traffic. You're thinking about dinner. Your phone buzzes in the center console. You glance down for just 1 second, a single second, and when you look up, you see nothing but red taillights. Bam! It's not a huge crash. A classic fender bender. You get out, the other driver seems okay, a little shaken up. You exchange information, file a police report, and call your insurance company. You've been paying for full coverage for years, so you think, okay, this is an expensive hassle, but this is why I have insurance. You think you're covered. A few weeks later, you get a letter in the mail. It's not from your insurance company. It's from a law firm. The other driver, the one who seemed fine at the scene, is now suing you. They're claiming severe back and neck injuries, emotional distress, and lost wages. The demand? $300,000. You laugh. It's absurd. Your insurance will handle this. So you call your agent, and that's when your entire world tilts on its axis. Your agent says, well, I'm looking at your policy, and your bodily injury liability limit is $50,000 per person. What does that mean? It means your insurance company will write a check for $50,000. And that's it. They're done. The other $250,000? That's on you. Suddenly, the equity in your home, your retirement savings, your kids' college fund, even your future wages. It's all on the line, about to be seized to pay for a 1-second mistake. This isn't a scare tactic. This exact scenario plays out every single day all across America. And it happens because millions of well-meaning, responsible people are driving around with a ticking financial time bomb in their glove box, and they don't even know it. That time bomb is their insurance policy. Specifically, it's the one part of their policy they've probably never looked at, the liability coverage. The single most important part of your auto insurance is not your deductible. It's not whether you have rental car coverage. It's a set of 3 little numbers that look something like this: 25/50/25, or 50/100/50, or 100/300/100. Do you know what your numbers are right now, without looking? If you don't, you're not alone. But I promise you, by the end of this video, you will not only understand exactly what those numbers mean, you will be able to look at your own policy and know with absolute certainty whether you are protected or dangerously exposed. We are going to pull back the curtain on the most misunderstood, yet most critical part of your auto insurance. We're going to demystify liability coverage, expose the single biggest myth that insurance companies and state governments quietly perpetuate, and give you a simple, powerful framework to choose the right coverage to protect everything you have worked so hard to build. This knowledge is your financial shield. Let's build it. So, what even is liability coverage? The word itself sounds complicated, like something lawyers would say, but the concept is incredibly simple. Liability means responsibility, legally and financially. If you cause an accident, you are liable or responsible for the damage you cause to other people and their property. Your liability insurance is what pays for their bills when you are at fault. Think of it this way: all the other parts of your insurance, like collision or comprehensive, are for fixing your car. Liability coverage has absolutely nothing to do with your car. It's a pot of money set aside to pay for the damage you do to everyone and everything else. It's the coverage that protects you from being sued into bankruptcy. It's the coverage that protects your assets. This protection is broken down into 2 main parts, and you'll see them listed right on your policy. The first is bodily injury liability. The second is property damage liability. Let's start with the big one. Bodily injury liability, or BI, covers the costs associated with injuries you cause to other people in an accident. This isn't just a simple ambulance ride. We're talking about everything: hospital stays, surgeries, doctor's visits, long-term physical therapy, medication. But it gets much, much bigger than that. It also covers lost wages. If the person you hit is a surgeon who can't work for 6 months because of a hand injury you caused, your insurance could be on the hook for hundreds of thousands of dollars in their lost income alone. And then there's the big, scary, unpredictable one: pain and suffering. This is the legal term for compensation for physical pain, emotional trauma, and the decreased quality of life resulting from an injury. There's no fixed price tag on this. It's what juries decide. And this is where a seemingly minor injury from that fender bender can explode into a six-figure lawsuit. The medical bills might only be $20,000, but a jury could award another $150,000 for pain and suffering. If your bodily injury limit is only $50,000, you can see how quickly you find yourself in that nightmare scenario we talked about. This is, without a doubt, the single greatest financial risk you face every time you get behind the wheel. The second half of the liability equation is property damage, or PD. This one seems more straightforward. If you are at fault, this coverage pays to repair or replace the other person's property that you damaged. Most people hear that and think, okay, so it pays for the other car. And yes, it does. But think about the cars on the road today. That's not just a 20-year-old Honda Civic anymore. What if you rear-end a brand new Tesla Model S Plaid? That's a $100,000 car. What if you hit a new Mercedes or a Rivian truck? The cost to repair modern cars with all their complex sensors and electronics is skyrocketing. A simple bumper replacement can run into the thousands, but property damage liability covers more than just other cars. It covers any property you damage. What if you swerve to avoid an animal and take out someone's expensive, custom-built brick mailbox and landscaping? That's your property damage coverage. What if you slide on ice and take out a city utility pole? You could be on the hook not just for the pole, but for the cost of the emergency repairs to restore power. What if you crash through the front of a building? A storefront? Someone's garage? I saw a claim once where a driver had a medical issue, lost control and drove through a city park, taking out benches, a water fountain, and a historical monument. The total property damage bill was over $80,000. His policy limit? $25,000. He was personally on the hook for the other $55,000. So let's put it all together. When you cause an accident, there are two types of damage. Damage to people, which is bodily injury, and damage to stuff, which is property damage. Your liability coverage is the amount of money your insurance company will pay to cover those damages on your behalf. Any cost above and beyond those limits comes directly out of your pocket. It's your house, your savings, your future. Now you understand the two core components. But how do you know how much of each you have? And how do you read those three little numbers on your policy? That's where we get to the heart of the matter. The split limit numbers like 50/100/25 that define your entire financial shield. Understanding how to decode them is the first step to making sure you are truly protected. And that's exactly what we're breaking down next. Those numbers, that /separated code on your insurance declaration page, isn't just jargon. It's the DNA of your financial security. Think of it like a combination to a vault. Get it wrong, and the vault is empty when you need it most. Get it right, and it protects everything you've worked for. Let's imagine a guy named Mark. He's 28, works in IT, and drives a reliable 5-year-old sedan. He's a good driver, a good guy. Like millions of Americans, when he bought his car insurance, he had one goal: be legal for the lowest possible price. His state requires a minimum liability coverage of 25/50/25. So that's what he bought. Cost him about $60 a month, and he felt smart for saving money. He tucked his proof of insurance in the glove box and didn't think about it again. One Tuesday afternoon, Mark is driving home from work. He's thinking about a project deadline, maybe what he's having for dinner. For just a split second, he glances down at his phone to check a notification. A harmless peek. But in that 1 second, the car in front of him, a brand new minivan, slams on its brakes. By the time Mark looks up, it's too late. The sound of crunching metal and shattering glass is sickening. He's okay, shaken but unhurt. But the family in the minivan is not so lucky. A mother, let's call her Sarah, has a broken arm and a serious back injury. Her husband, Tom, has severe whiplash. Their minivan, which they just bought a month ago, is totaled. A few weeks later, the calls start. Not from his insurance company, but from lawyers. The bills are piling up, and Mark is about to get a brutal real-world education in what those three little numbers on his policy actually mean. That first number on his 25/50/25 policy is 25. This stands for $25,000. It represents the maximum amount his insurance company will pay for bodily injury to a single person in an accident that he causes. Not for the whole accident, just for one individual. This covers their medical bills, their lost wages from being unable to work, and their pain and suffering. Sarah's medical bills alone, for the ambulance, the emergency room, the surgery on her arm, the ongoing physical therapy for her back, come to $70,000. And that's before you even calculate the income she lost as a freelance graphic designer or put a dollar amount on her chronic pain. Mark's insurance company looks at this and writes a check to Sarah's lawyer for $25,000. That's it. They've fulfilled their legal obligation. They have paid the maximum amount for a single person as defined by the policy Mark chose. But Sarah is still owed $45,000. And her lawyer's job is to get it for her. So where does that money come from? Comes from Mark. Suddenly, Mark is facing a lawsuit for $45,000. He doesn't have that kind of money in the bank. So Sarah's lawyers can go after his assets. They can put a lien on his car. They can file for a court order to garnish his wages, meaning a chunk of his paycheck will be taken out every single week for years until that debt is paid. His dream of buying a house is gone. His financial future is now owned by a single moment of distraction. All because that first number 25 was a brick wall when he needed a fortress. Now let's look at the second number, 50. This stands for $50,000. This is the maximum amount his policy will pay for total bodily injuries for everyone involved in a single accident. It's the total pot of money available for medical bills, no matter if you hit a car with one person or a bus with 10. Remember Sarah's husband, Tom? His whiplash and physical therapy bills came to $20,000. So, the total medical bills for the family are Sarah's $70,000 plus Tom's $20,000, which is $90,000. Mark's policy has that $50,000 total limit. His insurance already paid out $25,000 for Sarah. That means there's only $25,000 left in the pot for everyone else. So the policy can cover Tom's $20,000 bill in full. The insurance company writes another check. Now they have paid a total of $45,000 in bodily injury claims. $25,000 for Sarah and $20,000 for Tom. They are still under their $50,000 total limit. But imagine if Tom's injuries had been just a little worse. Imagine if his bills were $30,000 instead of $20,000. The policy would pay out its remaining $25,000, and Mark would be on the hook for Tom's remaining $5,000, in addition to the $45,000 he already owes Sarah. That second number is a cap on the total compassion your insurance company can show. Finally, we get to the third number. The last 25. This stands for $25,000 for property damage. This is the maximum amount the policy will pay for any property Mark destroys in an accident he causes. This is almost always the other person's car. But it could also be a storefront, a city light pole, or someone's fence. The family's brand new minivan? The one that's now a crumpled wreck? Its value was $40,000. Mark's insurance company assesses the damage and writes a check to the family's auto lender for $25,000. That's the limit. That's all they will pay. The family is still owed $15,000 for their vehicle. So their insurance company pays to cover the rest of their loan, and then that insurance company's legal department turns around and sues Mark to get that $15,000 back. It's a process called subrogation, and it's standard practice. So let's tally up the final score. Mark saved a few bucks a month on cheap insurance. And now, after one bad afternoon, he is personally, legally responsible for $45,000 to Sarah for her remaining medical bills, and another $15,000 to the other insurance company for the minivan. He is facing a total of $60,000 in personal debt. That's more than he makes in a year. His life has been fundamentally altered. The stress is immense. His credit will be destroyed. For years, every dollar he earns will be a reminder of that one glance at his phone. And here is the most painful part of this whole story. Mark could have prevented all of it. He could have increased his liability coverage from the state minimum 25/50/25 to something much more protective like 100/300/100. And the difference in his monthly premium? It might have been $20, maybe $30. The price of a few cups of coffee or a single pizza delivery. For less than $1 a day. He could have had a $100,000 shield for Sarah's injuries, a $300,000 total shield for the whole family, and a $100,000 shield for their minivan. Every single penny of that accident would have been covered. He would have filled out some paperwork, his rates might have gone up, but his life, his savings, and his future would have remained intact. Mark's story isn't an exaggeration. It happens every single day in every state across this country. People driving around with a false sense of security, thinking that because they have an insurance card they are protected. But they're not protected. They're just legal. And there is a massive life-shattering difference between the two. We've seen how dangerous the minimums are. We've walked through the financial devastation they can cause. The obvious question now is, what is the right amount? How do you know what numbers you should actually have on your policy to protect your life, your family, and your assets? Is 100/300/100 the magic number? Or do you need even more? It's not a one-size-fits-all answer. It depends on you. And in the next part, we are going to build your ideal policy from the ground up, figuring out the exact numbers that will turn your insurance from a piece of paper into a genuine fortress. Okay, let's get our hands dirty. Grab a metaphorical hard hat and a blueprint, because we are about to construct your financial shield piece by piece. The first thing any builder does is look at the foundation. In the world of auto insurance, the absolute bedrock is your state's minimum liability requirement. Every state, except for a couple of outliers, mandates that you carry a certain minimum amount of liability coverage to legally drive on their roads. This sounds responsible, right? The government is making sure everyone has at least some coverage. But here's the terrifying truth the insurance companies don't advertise. The state minimum is a trap. It's a financial landmine disguised as a safety net. Let's look at a common state minimum, something like 25/50/25. What on earth do these numbers mean? It's not a secret code. It's actually simple. The first number, 25, stands for $25,000. That's the maximum amount your insurance will pay for bodily injury to a single person you injure in an accident you cause. The second number, 50, stands for $50,000. That's the maximum total your insurance will pay for bodily injuries for everyone in the other car, combined. And the last number, 25, is $25,000 for property damage. This covers the other person's car, or maybe a fence you hit, or a fire hydrant. So 25/50/25. Bodily injury per person, bodily injury per accident, property damage per accident. Seems okay, right? 25 grand can cover a few doctor's visits. 50 grand should be plenty for a couple of people. And 25 grand can fix a pretty beat-up car. Now let's put that theory to the test in the real world. You're driving home, you glance down at your phone for just a second, it happens, and you rear end a brand new Toyota Highlander. Not a Ferrari, just a popular, reliable family SUV. The bumper is crushed, the tailgate is dented, the exhaust is bent. The driver and their passenger are complaining of neck and back pain. They get taken to the hospital in an ambulance just to be safe. Let's do the math. The average cost of an ambulance ride can be over $1,000. A visit to the emergency room, even without being admitted, can easily be a few thousand more. Add in X-rays, MRIs, and follow-up physical therapy for whiplash, and suddenly that $25,000 per person limit is looking awfully small. What if one person needs minor surgery? Their bills alone could hit $30,000, $40,000 or more. Your policy pays the first $25,000. The other $15,000? That's on you. The second person's bills are, let's say, $10,000. Your policy covers that. So far, your insurance has paid out $35,000 for injuries, which is under the $50,000 total limit. You're okay there. But what about the car? A new Highlander can cost over $40,000. The repair bill for the damage you caused comes in at $18,000. Your $25,000 property damage limit covers this. Great, but what if you had hit a Lexus? A new BMW? What if you had swerved and hit a city light pole, which can cost $10,000 to replace, before you even factor in the car? In our simple fender bender, you are already personally on the hook for $15,000 in medical bills. And this was a minor accident. Imagine if the other driver was a surgeon who couldn't work for 3 months because of a hand injury. Now you're not just paying for medical bills. You're being sued for lost wages, which could be hundreds of thousands of dollars. Your state minimum policy of 25/50/25 is now a paper-thin shield against a financial wildfire. It's gone in an instant. And everything you own, everything you've worked for, is now fuel for that fire. Your savings account, your investments, the equity in your home, they can all be seized to pay the judgment against you. So, if the state minimum is a trap, how do you know what's right? The answer starts with a simple, powerful rule of thumb used by financial advisors everywhere. You need enough liability insurance to cover your net worth. Let that sink in. The entire purpose of liability coverage is to protect your assets. It's a shield for your stuff. If you have a shield that's smaller than the thing you're trying to protect, it's not a very good shield. So, how do you figure out your net worth? It's not as complicated as it sounds. You don't need a team of accountants. Grab a napkin. On one side, write down your assets, the things you own. This includes the equity in your home, what it's worth minus what you owe on the mortgage, the money in your savings and checking accounts, the value of your retirement accounts like a 401k or IRA, any non-retirement investments, and the value of major possessions like your car. On the other side of the napkin, write down your liabilities, what you owe. This is your mortgage balance, your car loan, student loans, and any significant credit card debt. Now, just subtract your liabilities from your assets. The number you're left with is your approximate net worth. If you have $200,000 in assets and $50,000 in debt, your net worth is $150,000. This number is your starting point. This is the absolute minimum amount of liability coverage you should even consider. Why? Because if you get into a serious accident and you're sued for $200,000, but you only have a $50,000 liability policy, the other party's lawyers will come after your $150,000 in assets to make up the difference. Your insurance company writes a check for $50,000, wishes you luck, and walks away. You're left to face the rest alone. But we're not just building a basic shelter here. We're building a fortress. And a true fortress doesn't just protect what you have today. It protects what you will have tomorrow. This brings us to the most overlooked and most important factor in choosing your liability limits: your future income. A court judgment doesn't just look at your bank account. It looks at your paycheck. If the damages you cause exceed your insurance limits and your current assets, they can garnish your future wages. This means that for years, even decades, a portion of every single paycheck you earn could be taken from you before you even see it. Think about that. A single mistake on the road could financially cripple you for the rest of your working life. This is especially critical for young professionals. A newly graduated doctor might have a negative net worth because of massive student loans. But her future earning potential is enormous. A lawyer suing her isn't just looking at her empty bank account. They're looking at the millions of dollars she's projected to earn over her career. So, how do we translate all of this into actual numbers you can ask your insurance agent for? Let's stop talking theory and start building the policy. I'm going to give you 3 common tiers of coverage. See which one feels right for you. Tier 1, let's call it the good foundation. This is for someone with limited assets and a modest income. Instead of the state minimum trap of 25/50/25, you upgrade to 50/100/50. That's $50,000 for a single person's injuries, $100,000 total for all injuries, and $50,000 for property damage. This provides a much more realistic buffer for a common accident and ensures a simple fender bender doesn't bankrupt you. It also covers the replacement cost of most vehicles on the road. Tier 2. The responsible fortress. This is the sweet spot for the vast majority of people. This is for homeowners, families, and anyone with a decent job and some savings. The numbers here are 100/300/100, 100,000 for one person, 300,000 total for injuries, and 100,000 for property damage. This level of coverage can handle a more serious multi-car accident. It provides a substantial defense against lawsuits for lost wages, and can withstand the kind of expensive, long-term medical care that can result from a bad crash. This is the level where you can start to sleep soundly at night. Tier 3. The maximum security vault. This is for high-income earners, people with significant assets, or simply those who want the absolute best protection available. The numbers are typically $250,000/500/100. That's $250,000 for one person's injuries, $500,000 total, and $100,000 for property. This is a serious policy for serious protection. It's designed to shield a lifetime of work and savings from a catastrophic event. Now I know what you're thinking. That sounds expensive. Jumping from state minimum to 100/300/100 must cost a fortune. And this is the single biggest misconception in all of auto insurance. The price difference is shockingly small. The vast majority of the cost of your premium is for that first layer of basic coverage. Each additional layer of protection you add gets progressively cheaper. The jump from the trap of a 25/50/25 policy to the fortress of a 100/300/100 policy might only be $10 or $15 a month. It is without a doubt the cheapest peace of mind you will ever buy. For the price of a few cups of coffee, you are literally buying protection for your entire financial life. So now you know how to build your shield. You know how to calculate what you need to protect, and you have concrete numbers to start with. We've built a powerful fortress to protect your assets if you cause an accident. But there's a flaw in our fortress. It has a gate. And that gate is only designed to defend against attacks coming from one direction. We've built a shield to protect others from you. But what about the shield that protects you from them? What happens when the person who hits you has no insurance or worse, has one of those paper-thin state minimum policies? That's where the story gets even more personal, and potentially a lot more frightening. Imagine the scene. The crunch of metal, the hiss of a deployed airbag, that split second of ringing silence before the world comes rushing back in. You're shaken, but you're okay. You get out of your car, see the damage, and your heart sinks. But then a wave of relief. The other driver clearly ran the red light. It wasn't your fault. You did everything right. You have good insurance. You're covered. The other driver gets out, also shaken but apologetic. They admit fault. You exchange information. And that's when they look down at their shoes and mutter the 5 words that can turn a bad day into a financial catastrophe. I don't have any insurance. Suddenly, that liability shield we just talked about, it's pointing the wrong way. Your bodily injury and property damage liability coverage is designed to pay for the people you hit. It does absolutely nothing for you, your passengers, or your car in this situation. The person who is legally and financially responsible for making you whole has nothing. They are a ghost, a financial black hole. So, who pays for your totaled car? Who pays for your hospital visit, the x-rays, the physical therapy you'll need for the next 6 months? Who covers the wages you lose from being unable to work? In the eyes of the law, the other driver owes you all of it. You could sue them, and you might even win. But you cannot get blood from a stone. Winning a judgment against someone with no assets and no income is like winning a lottery ticket that expired last year. It's a piece of paper that represents a victory, but it's ultimately worthless. You're left holding the bag for someone else's mistake. This isn't some rare 1 in a million scenario. According to the Insurance Research Council, about 1 in every 8 drivers on the road in the United States is uninsured. That's more than 12%. In some states, it's as high as 1 in 4. Think about that. On your commute to work today, you likely shared the road with dozens, if not hundreds, of these ghost drivers who have absolutely no ability to pay for the damage they might cause. This is where your own insurance policy has a hidden hero. A secret weapon you absolutely need to know about. It's called uninsured and underinsured motorist coverage. Let's call it UM and UIM for short. This is not liability coverage. This is protection for you. Think of it as a clone of a good liability policy that you buy for yourself, and it only activates when the person who hits you is a ghost. Let's break down uninsured motorist coverage first. UM steps in when you're hit by someone with zero insurance. It also, crucially, often covers you in a hit and run. Someone sideswipes you on the highway and speeds off? You get their license plate, but it's a stolen car? In the eyes of your insurance, that's an uninsured motorist. Uninsured motorist coverage typically comes in 2 parts, just like liability. There's uninsured motorist bodily injury, or UMBI. This is the big one. This is what pays for your medical bills, your passengers' medical bills, your lost wages, and even pain and suffering, up to the limits you select. If that uninsured driver puts you in the hospital for a week with bills totaling $50,000, your UMBI coverage is what swoops in to pay that $50,000. Without it, that bill is yours and yours alone. Then there's uninsured motorist property damage, or UMPD. This, as the name implies, pays to repair or replace your car if it's damaged by an uninsured driver. Now some of you might be thinking, wait, wouldn't my collision coverage pay for my car? And you're right, it would. We'll get to collision in a later part. But UMPD can be a great alternative. The deductible is often much lower than a collision deductible, and in some states, using your UMPD won't be considered an at-fault accident, which can help keep your rates from going up. It's a specific tool for a specific and unfortunately common problem. So that's the ghost driver with no insurance. But what about the second, more subtle nightmare we mentioned? The driver with the paper-thin, state minimum policy. This is where underinsured motorist coverage, or UIM, becomes your financial savior. Let's go back to that crash scene. But this time, the other driver doesn't say they have no insurance. They proudly hand you their proof of insurance. You breathe a sigh of relief. But later, you discover they only have the bare minimum required by their state. Let's say it's $25,000 in bodily injury liability. Now let's say your injuries are serious. The ambulance ride, the emergency room, the surgery on your broken leg. The bills stack up fast. Your final medical tally is $90,000. Plus, you've missed 2 months of work, losing another $10,000 in income. Your total damages are $100,000. The at-fault driver's insurance company cuts you a check for their policy limit, $25,000. That's all they have. That's all they are legally required to pay. So where does the other $75,000 come from? Without underinsured motorist coverage, it comes from your savings. Your retirement fund, a second mortgage on your house, comes from you. But if you have underinsured motorist bodily injury coverage, or UIMBI, your own insurance company steps in to bridge that gap. If you had, say, $100,000 in UIMBI coverage, after you receive the $25,000 from the other driver's policy, your UIMBI coverage could then pay the remaining $75,000. It literally covers you when the other person is underinsured for the damage they caused. It fills the void left by their irresponsible choice to carry a policy that can't even cover the cost of a single serious injury in today's world. Here's the critical takeaway: your liability limits, the 100/300/50 we talked about before, protect other people from you. Your uninsured and underinsured motorist limits should be seen as the protection you buy for yourself from other people. It's the armor you wear against the ghosts and the underprotected drivers on the road. And for that reason, I'm going to tell you something most people never consider. Your UM/UIM limits should be, at a minimum, an exact mirror of your own liability limits. If you believe you need $100,000 of bodily injury liability to protect your assets from someone you might injure, why on earth would you accept less than that to protect yourself and your family from being injured by someone else? Your health, your ability to earn an income, your financial stability, aren't they worth just as much? The cost to increase these coverages is often shockingly small. We're talking about a few extra dollars a month to go from a state minimum level of protection to a robust shield that could prevent a financial apocalypse. It is, without a doubt, one of the best bargains in the entire world of insurance. So we've built the first two walls of our fortress. We have liability coverage to protect us from lawsuits when we're at fault. And now we have UM/UIM coverage to protect us from financial ruin when someone else is at fault but can't pay. We've protected our assets from others, and our health from others. But what about the single most expensive asset that's actually involved in the crash? What about the thousands or tens of thousands of dollars of steel, glass, and technology that you're driving? What happens when you're the one at fault? Or when nobody is at fault? What happens when you hit a patch of black ice and slide into a guardrail? Or a deer jumps out in front of you on a country road? Or a hailstorm turns your car's hood into a golf ball? Your liability won't help you. The deer doesn't have insurance. Who pays to fix your car then? That, my friends, is the million-dollar question. Or, more accurately, the $5, $10, or even $50,000 question depending on the car you drive. The answer is simple and a little terrifying. You do. You pay for it. Every single penny. Unless you have what's known as first-party coverage. While liability is all about paying for damage you do to others, first-party coverage is all about fixing your stuff. And when it comes to your car, this protection comes in two main flavors: collision and comprehensive. Let's start with collision. The name is pretty self-explanatory. Collision coverage pays to repair or replace your own vehicle after it's been damaged in a collision with another object. That object could be another car, of course, but it could also be a telephone pole, a parking garage pillar, a fire hydrant, or that guardrail you slid into on the black ice. The key takeaway here is that collision coverage applies regardless of who is at fault. Think back to our example from the last part. You cause an accident. Your liability coverage pays to fix the other person's brand new SUV, but your own car is a crumpled mess. If you have collision coverage, you can file a claim with your own insurance company to get your car fixed. If you don't have collision, you're on your own. You'll be heading to the body shop with your own checkbook, or more likely, to the junkyard to say your goodbyes. Collision also saves you in situations where fault is unclear, or when the other driver is uninsured and can't pay. Or what about a hit and run? Someone smashes your car in a parking lot and just drives off. There's no one to hold liable. Without collision coverage, that's just tough luck. With it, you're protected. It's the safety net for your own vehicle when things go wrong on the road. So that covers the ice and the guardrail. But what about the deer? Or the hailstorm? Hitting a deer isn't really a collision in the same way hitting a car is, and you certainly didn't collide with the hailstones. This is where the second flavor of protection comes in: comprehensive coverage. If collision is for damage from crashing into things, comprehensive is for almost everything else. It's sometimes called other than collision coverage. This is your protection against the weird, the random, The acts of nature and malice that can damage your car when it's not even moving. The deer that jumped out in front of you? That's a comprehensive claim. The hailstorm that turned your hood into a lunar landscape? Comprehensive. A tree branch snaps in a windstorm and crushes your roof? Comprehensive. Someone keys your car from bumper to bumper out of spite? Comprehensive. Your car gets stolen from your driveway? Comprehensive. Catches on fire? It gets caught in a flood? It gets hit by a falling satellite? Okay, maybe not the satellite, but you get the idea. All of these are covered under comprehensive. A simple way to remember the difference is this. Collision is for when your car hits something. Comprehensive is for when something happens to your car. One is about driving incidents, the other is about environmental or criminal incidents. Now, here's a critical point that trips up a lot of beginners. Unlike liability insurance, which is required by law in nearly every state, collision and comprehensive are technically optional. No state law says you have to buy them. However, and this is a massive however, if you have a loan on your car or you are leasing it, your lender or leasing company will almost certainly require you to have both. Why? Because until you pay it off, they are the true owners of that vehicle. It's their asset, their collateral. They need to protect their investment. If you crash a car you still owe $20,000 on and you don't have collision coverage, you're not the only one who loses. The bank loses its $20,000. So they mandate that you carry both coverages to ensure the car can be repaired or replaced, making them whole. Once you own the car outright, title in hand, no more payments, the choice is entirely yours. You can keep the coverages for peace of mind, or you can drop them to save money on your premium. And that brings us to the single most important concept you need to understand when it comes to collision and comprehensive: the deductible. A deductible is the amount of money you have to pay out of pocket for a repair before your insurance company starts paying. You choose your deductible amount when you buy your policy. Common amounts are $250, $500, $1,000, or even $2,500. Let's walk through a real-world example. Say you have a collision policy with a $500 deductible. You back into a pole in a parking lot, and the body shop quotes you $3,000 for the repairs. When you file the claim, you are responsible for the first $500. You pay that directly to the body shop. Your insurance company then pays the remaining $2,500. If the damage was only $400, you wouldn't even file a claim because the repair cost is less than your deductible. You just pay it yourself. The deductible applies to both collision and comprehensive, and you can often choose different amounts for each. The relationship between your deductible and your premium, the amount you pay for your policy, is an inverse one. It's a seesaw. A higher deductible means a lower premium. A lower deductible means a higher premium. If you choose a $1,000 deductible, you're telling the insurance company, I'm willing to take on a bigger chunk of the financial risk myself in case of an accident. The insurance company likes this. It means they'll have to pay out less often and less money when they do. So they reward you with a lower monthly or semi-annual bill. If you choose a $250 deductible, you're saying, I want to take on as little risk as possible. I want you, the insurer, to cover almost everything. This makes you a higher potential cost to the insurer, so they charge you a higher premium to compensate for that increased risk. Choosing the right deductible is a personal financial decision. The big question to ask yourself is, how much cash could I comfortably access on short notice without causing a financial crisis for my family? If writing a check for $1,000 would be a major hardship, then a lower deductible, despite the higher premium, might be the safer bet. But if you have a healthy emergency fund, opting for a higher deductible can be a smart way to save hundreds of dollars a year on your insurance costs. Now, you've probably heard the term full coverage. People say it all the time. Oh, don't worry, I've got full coverage. But here's an industry secret. Full coverage isn't actually a real type of insurance. You can't call an agent and say, sell me one full coverage. It's just a common informal phrase people use to describe a policy that bundles together the three main pillars we've discussed: liability, collision, and comprehensive. So when someone says they have full coverage, what they really mean is they have a policy that protects them if they hurt someone else or damage their property, and protects their own car from both collisions and other types of damage. It's the complete package of basic protection for both you and others. So let's put it all together. You've chosen your liability limits to protect your assets. You've added collision and comprehensive to protect your own car. You've selected a deductible you can afford. You're all set, right? You get into an accident, you pay your deductible, and the insurance company pays the rest. It's that simple. Well, mostly. There's one final massive wrinkle in this whole process. You file your claim, the adjuster comes out, and the body shop writes up an estimate. The repair bill is $8,000. But your car, your trusty 10-year-old sedan, is only worth $5,000 on a good day. What happens then? Does the insurance company really pay $8,000 to fix a $5,000 car? The answer to that is a hard no. And it introduces a concept that every car owner needs to understand: the dreaded declaration of a total loss. So what does it mean when a car is totaled? Most people picture a twisted, smoldering heap of metal that's barely recognizable as a vehicle. And sure, that's a total loss. But a car can look almost fine, with just a few dented panels, and still be declared a total loss. Why? Because a total loss isn't about how wrecked the car looks. It's a cold, hard, economic calculation made by the insurance company. The only question they're asking is this: is it cheaper for us to pay to fix your car? Or is it cheaper for us to just write you a check for what your car was worth and take the wreck off your hands? To understand this calculation, you first have to get familiar with the single most important term in this entire process: actual cash value, or ACV. Actual cash value is what your car was worth 1 second before the accident happened. It is not what you paid for it. It is not what you still owe on it. It is not what it would cost to buy a brand new one. It is the fair market value of your specific car, your 2015 Honda Accord with 95,000 miles, a small stain on the passenger seat, and that little scratch on the bumper in your local market on the day of the crash. Think of it like this: if you were going to sell your car on Craigslist or Facebook Marketplace the morning of the accident, ACV is the realistic price you would have gotten for it. It's the price minus depreciation. This is where a lot of friction happens. People get angry. They say, "My car was perfect. It's worth way more than that." But insurance adjusters spend their entire day evaluating vehicle values. They use sophisticated software that pulls data from local dealership sales, private party listings, and auction results for cars just like yours. They are looking at the year, make, model, trim level, mileage, overall condition, and any optional features. Their initial offer is based on that data. So let's say the adjuster determines that the actual cash value, the ACV, of your car right before the crash was $5,000. Now, the insurance company has to make a choice. Do they pay the $8,000 repair bill? Or do they pay you the $5,000 ACV? The choice seems obvious. They'll pay the ACV. But what if the repair estimate was only $4,000? Now it's not so clear. $4,000 to fix it is less than the $5,000 it's worth. So they'll pay for the repairs, right? Not so fast. This is where the secret part of the formula comes in. It's called the total loss formula. And it's what trips up almost everyone. It goes like this. An insurance company will declare a car a total loss if the cost of repairs plus the car's salvage value is greater than or equal to its actual cash value. We know the cost of repairs. That's the $4,000 estimate from the body shop. We know the actual cash value. The adjuster said it's $5,000. But what on earth is salvage value? Salvage value is what the wrecked, unrepaired car is worth. Even a damaged car has value. It can be sold at a salvage auction to body shops for parts, to scrap metal dealers, or to rebuilders. The engine might be perfectly fine. The transmission could be good. The doors on the undamaged side are perfectly usable. A company like Copart or a local salvage yard will pay money for that wreck. Let's say the insurance company knows they can sell your wrecked car at auction for about $1,500. That's its salvage value. Now let's plug that into the formula. The cost of repair is $4,000. The salvage value is $1,500. Add them together. That equals $5,500. Now, compare that to the actual cash value of $5,000. $5,500 is more than $5,000. And just like that, your car is a total loss. This is a huge revelation for most people. Your car, with only $4,000 in damage, less than its $5,000 value, is being sent to the scrapyard. Seems insane, but look at it from the insurance company's perspective. It's simple math. Option A is to pay the $4,000 to fix your car. Their net cost is $4,000. Option B is to pay you the $5,000 actual cash value. They take your car, sell it for salvage for $1,500, and recoup that money. So their net cost is $5,000 minus $1,500, which is only $3,500. $3,500 is less than $4,000. They choose the cheaper option every single time. It's not personal, it's just business. So what happens next? The adjuster calls you and delivers the news. Your vehicle has been deemed a total loss. They will make you an offer, which is their determination of the ACV. In our case, $5,000. If you accept, they will cut you a check for that amount. You, in turn, will sign over the car's title to them. They effectively buy your wrecked car from you. They then take it, sell it at a salvage auction, and the process is over. You have a check in your hand and you no longer have a car. But what if you think their offer is too low? What if you believe your car was worth $6,500, not $5,000? You do not have to accept the first offer. You have the right to negotiate. But you can't just say, "I want more." You need to bring evidence. This is your homework. Go online to sites like AutoTrader, Cars.com, and even Facebook Marketplace. Find several examples of cars that are the exact same year, make, model, and trim as yours, for sale in your local area, with similar mileage and in similar condition. If you recently put on a brand new set of tires, had a new transmission put in, or installed an expensive audio system, find the receipts. Present this evidence to the adjuster in a calm, organized email. Say, "I appreciate your initial valuation. However, based on these comparable vehicles for sale right now in our zip code, and my recent major repairs, I believe a more accurate ACV would be $6,500. This shows them you've done your research and are serious. Often, they will meet you somewhere in the middle. Now, there's another question people always ask. Can I keep my car? Maybe the damage is mostly cosmetic, it still drives fine, and you have a sentimental attachment to it. The answer is usually yes. This is called an owner-retained salvage. But be very careful here. If you choose to do this, the insurance company will still pay you, but they'll use a different formula. They'll pay you the actual cash value minus the salvage value. So, in our example, they'd pay you $5,000 minus the $1,500 they would have gotten at auction. You get a check for $3,500 and you get to keep your broken car. The problem is, the state DMV is notified, and your car's clean title is replaced with a salvage title. This is a permanent brand on the vehicle's history, telling everyone it was once declared a total loss. Getting insurance for a salvage title car is incredibly difficult and expensive, and its resale value plummets to almost zero. For 99% of people, keeping the car is a bad financial move. But we've saved the most painful scenario for last. It's a financial trap that ruins thousands of people every year. Let's go back to our totaled car. The ACV is $5,000. But what if you bought that car a few years ago with a small down payment and you still owe your lender, the bank, $7,000 on your car loan? The insurance company cuts a check for $5,000. Because the bank has a lien on your car, that check doesn't even go to you. It goes directly to the bank. The bank applies that $5,000 to your $7,000 loan. And now you are left with no car, and a bill from the bank for the remaining $2,000 you still owe. This is called being upside down on your loan, and the difference between what you owe and what the car is worth is called the gap. You are legally required to pay that $2,000 gap for a car you don't even have anymore. It is a devastating financial blow. This nightmare scenario is precisely why something called gap insurance exists. It's an optional coverage you can often buy from the dealership, your bank, or sometimes your own insurance company when you first buy a car. And its only job is to pay off that $2,000 gap in the event of a total loss. It is an absolute lifesaver, especially if you're financing a car with little to no money down. Understanding the total loss process is about protecting yourself financially. It's about knowing the rules of the game, the ACV, the formula, the salvage value, so you can navigate the process and not get taken advantage of. But everything we've talked about so far, bodily injury, property damage, and this total loss scenario, has all been about the liability coverage on your policy. It's all been about paying for damage you caused to other people. So what happens when the accident is your fault? Or what if a tree falls on your car, or it gets stolen? Who pays to fix or replace your car then? That's where the other side of your policy comes in, the coverages that protect you and your own vehicle. And that's exactly where we're going next. So, think of your car as being protected by two different shields. These shields are called collision coverage and comprehensive coverage. They are the parts of your policy designed to fix or replace your car, and they are probably the most misunderstood parts of any auto insurance policy. Let's break them down, starting with the first shield. Collision. The name is pretty self-explanatory. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object. The most obvious example is hitting another car. But it's much broader than that. Collision coverage also applies if you hit a stationary object, like a telephone pole, a guardrail, a fence, or even if you accidentally back into your own garage door. It also covers damage from rolling your car in an accident or from hitting a nasty pothole that causes you to lose control and crash. Here's the most important thing to understand about collision coverage. It pays for damage to your car regardless of who is at fault. If the accident was your fault, your collision coverage kicks in to fix your car. If the accident was the other driver's fault, you could file a claim with their liability insurance like we talked about before. But what if they don't have enough insurance? Or what if they're fighting the claim? Or what if it's a hit and run and you have no idea who hit you? In all those cases, you can use your own collision coverage to get your car fixed right away, and let your insurance company worry about chasing down the other party for the money. It's your safety net for getting your car back on the road quickly after a crash. So that's the first shield: collision. Protects you from, well, collisions. But what about all the other crazy things that can happen to a car? What if you walk out of the grocery store to find a giant dent from a runaway shopping cart? What if a hailstorm makes your car look like a golf ball? What if a deer decides to play chicken with you on a country road at midnight? None of those are technically collisions with another vehicle or a stationary object in the traditional sense. That's where your second shield comes in. It's called comprehensive coverage, and you can think of it as the everything else or acts of God coverage. In fact, some insurance companies literally call it other than collision coverage, which is a perfect description. Comprehensive pays for damage to your car from a whole list of non-crash related events. This includes theft, vandalism, fire, explosions, earthquakes, windstorms, hail, water, and floods. It covers riots and civil commotion. It covers falling objects like a tree branch or a piece of debris from an overpass. And crucially, it covers you if you hit an animal like a bird or a deer. So let's make it crystal clear. You swerve to avoid a deer and hit a tree? That's a collision claim. You don't swerve and you hit the deer? That's a comprehensive claim. It seems strange, but that's how the industry classifies it. The easiest way to remember is, collision is for when your car hits something. Comprehensive is for when something happens to your car. Now, both of these coverages, collision and comprehensive, come with a very important catch. It's a word you've definitely heard before, but you might not fully understand how it works. That word is deductible. A deductible is the amount of money you have to pay out of your own pocket for a claim before the insurance company pays a single dime. You and the insurance company are sharing the risk, and the deductible is your share of it. Let's walk through an example. Say you have a collision policy with a $500 deductible. You're trying to parallel park, you misjudge the distance, and you crunch your bumper on a pole. You take it to the body shop, and they give you an estimate for $2,000 to fix it. Because you have a $500 deductible, you pay the first $500 directly to the repair shop. Your insurance company then pays the remaining $1,500. You've shared the cost. Now, what if the damage was minor? What if the repair estimate was only $450? In that case, you wouldn't even file a claim. Because the total cost of the repair is less than your deductible, the insurance company wouldn't pay anything anyway. You would just pay the $450 yourself. This is why you don't file claims for every little scratch and ding. Collision and comprehensive coverages each have their own separate deductible. You choose these amounts when you buy your policy. Common deductible amounts are $250, $500, $1,000, or even higher. And this brings us to one of the most powerful ways you can control the cost of your insurance premium. There is a simple inverse relationship between your deductible and your premium. The higher your deductible, the lower your monthly premium will be. The lower your deductible, the higher your monthly premium will be. Why? Think about it from the insurance company's perspective. If you choose a high deductible, say $1,000, you are telling them, I'm willing to handle any smaller problems myself. Don't bother me unless the damage is over $1,000. This means you'll file fewer claims, which makes you less of a risk to them, so they reward you with a lower price. On the other hand, if you choose a low deductible like $250, you're telling them you want them to step in for even minor incidents. This means you're more likely to file claims, which makes you a bigger risk, so they charge you a higher premium. So which should you choose? The golden rule is to pick the highest deductible you can comfortably afford to pay at a moment's notice. Don't choose a $1,500 deductible just to save $20 a month if you don't have $1,500 sitting in an emergency fund. If you get in an accident, your car will be stuck at the shop until you can come up with that money. A $500 deductible is a very common and manageable middle ground for most people. Now for the big question. Are these two shields, collision and comprehensive, required? Unlike liability coverage, No state in the US legally requires you to carry collision or comprehensive coverage. The law only cares about you being able to pay for damage you cause to others. However, there is a giant exception. If you have a loan on your car or if you are leasing it, the bank or the finance company that holds the title will almost certainly require you to have both collision and comprehensive coverage. Why? Because until you pay it off, it's not really your car, it's their car. It's their asset. They need to protect their investment. If you total the car without this coverage, you would still owe them the full balance of the loan, but you'd have no car to show for it. So, they mandate the coverage to make sure they can get their money back from the insurance company. This leads to the final critical piece of advice. What if your car is paid off? When does it make sense to drop these coverages and save the money? The decision comes down to one thing: the value of your car versus the cost of the coverage. Insurance will only ever pay out up to the actual cash value, or ACV of your vehicle at the time of the accident. That's what it's worth on the open market, with its age and mileage, not what you paid for it years ago. A good rule of thumb many financial experts use is the 10% rule. If the annual cost of your collision and comprehensive coverage is more than 10% of your car's value, you should seriously consider dropping it. Let's use an example. You drive a 12-year-old sedan that's fully paid off. You look it up online and its private party value is about $4,000. You check your insurance policy and see you're paying $50 a month, or $600 a year, for collision and comprehensive. That $600 is 15% of your car's $4,000 value. Now let's do the math. If you total the car, the insurance company will write you a check for $4,000, minus your deductible. Let's say your deductible is $500. So, you get a check for $3,500. The question you have to ask yourself is this: is it worth paying $600 every single year for the potential of a $3,500 payout? For many people, the answer is no. They would rather drop the coverage, save that $600 a year, and put it into a personal savings account for car repairs or a down payment on a new car. They choose to self-insure the risk. If the car gets totaled, it's a loss but not a catastrophic one. For someone else, that peace of mind might be worth the $600 a year. There's no single right answer, but you need to run the numbers on your own car to make an informed decision. So, we've now covered the two major pillars of auto insurance. We have liability, which protects other people from you, and we have collision and comprehensive, which protect your own car from damage. But we're still missing a huge piece of the puzzle. What about people? What about injuries? What happens if you or your passengers are hurt in an accident? Who pays for those medical bills? And what if the person who hit you has no insurance at all? How do you protect yourself from financial ruin then? That's the critical area we're diving into next. This is where the entire philosophy of insurance flips on its head. Up until now, everything we've talked about, bodily injury liability, property damage liability, has been about paying for damage you cause to other people. It's your financial shield to protect you from lawsuits. But it does absolutely nothing for you, your body, or your passengers. It won't pay a single one of your hospital bills. It won't replace a dime of your lost income. That's why we have this next set of coverages. This isn't about protecting your assets anymore. This is about protecting you. Let's start with the first line of defense: medical payments coverage, or as it's commonly known, MedPay. Think of MedPay as a small, dedicated health insurance policy that lives inside your car. Its job is simple and incredibly important. It pays for the medical and funeral expenses for you and any passengers in your car who are injured in an accident, regardless of who was at fault. Let that sink in. Regardless of fault. This is a game changer. In the chaotic moments after a crash, the last thing you want to do is argue with an insurance adjuster about who ran what red light while you're sitting in an emergency room. MedPay doesn't care. It sees a medical bill from the accident and it pays it up to the limit you select. We're talking about ambulance rides, ER visits, doctor bills, x-rays, surgery, even dental work if your teeth get damaged. The limits are typically modest, often ranging from $1,000 to $10,000, but its power isn't in the amount, it's in the speed and certainty. It's the immediate financial first aid that kicks in while the bigger, more complicated questions of fault are sorted out. Now, a common question I hear is, wait, I already have good health insurance. Why would I pay extra for MedPay? It's a fair question, but the answer reveals why MedPay is so clever. First, your health insurance has a deductible, right? It could be $500, $1,000, maybe $5,000 or more. MedPay can be used to pay that deductible so you have zero out-of-pocket costs. Second, your health insurance has co-pays and co-insurance. MedPay can cover those too. Third, and this is a big one, some health insurance plans have exclusions for injuries sustained in auto accidents, or they might not cover specific things like ambulance services or chiropractic care. MedPay is designed specifically for this scenario and fills those gaps. It's a relatively inexpensive cushion that ensures you can get the care you need right away without worrying about the cost. But what if you need more than just a cushion? What if an injury is so severe it doesn't just create medical bills, it destroys your ability to earn a living? For that, we have the supercharged big brother of MedPay, Personal Injury Protection or PIP. PIP is so important that in about a dozen states, known as no-fault states, it's mandatory. In a no-fault state, your own PIP coverage is your primary source for injury-related expenses, which helps speed up payments and reduce lawsuits. But even in states where it's optional, it is an incredibly powerful tool. Like MedPay, PIP covers your medical expenses regardless of fault, but it goes so much further. The single most important feature of PIP is that it can cover a percentage of your lost wages. Imagine you're a freelance graphic designer or a construction worker. You get into a nasty accident, break your arm, and can't work for 2 months. Your health insurance might cover the surgery, but who's going to pay your mortgage? Who's going to buy groceries for your family? The at-fault driver's insurance? Maybe eventually after weeks or months of investigation and negotiation. But your bills are due now. This is where PIP becomes a lifeline. It steps in and replaces a portion of your income, keeping your life from spiraling into financial disaster while you recover. And it doesn't stop there. PIP can also cover essential services. Say you're a stay-at-home parent who gets injured. You can't do the laundry, you can't clean the house, you can't take care of your kids. PIP can help pay for services like a cleaning crew or childcare while you're laid up. It understands that your contribution to the household has a real, tangible economic value. So MedPay is the first aid kit. PIP is the full-blown trauma center, designed to treat not just your physical injuries, but the financial injuries that come with them. Okay, so you have MedPay or PIP. Your immediate medical bills and lost wages are taken care of. You're feeling protected. But now we have to talk about the single biggest threat on the road. It's not drunk drivers, it's not texters, it's not icy roads. It's the person who hits you and has no insurance at all. According to the most recent data, nearly 1 in every 8 drivers in the United States is uninsured. In some states, it's as high as 1 in 4. These are people driving multi-thousand-pound machines at high speeds with absolutely zero financial backing if they cause a catastrophe. If one of them plows into you and sends you to the hospital for 6 months, their "I'm sorry" doesn't pay your bills. This is where you need your ultimate shield: uninsured and underinsured motorist coverage. UM and UIM. Let's break it down. Uninsured motorist coverage, or UM, does exactly what it sounds like. It steps in and acts like the at-fault driver's insurance when they don't have any. It's you insuring yourself against the irresponsibility of others. UM coverage typically comes in 2 parts. First, there's uninsured motorist bodily injury, or UMBI. This is the non-negotiable, must-have part. If an uninsured driver injures you or your passengers, UMBI pays for your medical bills, your lost wages, and crucially, for your pain and suffering. This is a massive distinction. MedPay and PIP are fantastic for economic damages, the things with a clear price tag. But they don't compensate you for the chronic pain, the trauma, the permanent limp, or the scar across your face that you now have to live with for the rest of your life. UMBI does. It provides the compensation you would have been entitled to sue the other driver for, if they'd actually had insurance to pay for it. It even protects you if you're a pedestrian or a cyclist, and you're the victim of a hit and run. The second part is uninsured motorist property damage, or UMPD. This covers the repairs to your car if it's damaged by an uninsured driver. Now we'll talk about another coverage called collision in the next part, which also covers your car's repairs. Sometimes UMPD can be a good, cheaper alternative if you don't want to pay for full collision coverage, but they both serve a similar purpose in this specific scenario. But what about the other side of the coin? What if the driver who hits you does have insurance, but they only bought the absolute bare minimum required by law? Imagine your state's minimum bodily injury liability is just $25,000. Someone texting and driving runs a stop sign, T-bones your car, and your injuries result in $150,000 in medical bills and lost wages. The at-fault driver's insurance company will write you a check for their policy limit, $25,000, and wash their hands of the situation. You are now left with a $125,000 hole. You can try to sue the driver personally, but the odds are, if they only had minimum insurance, they don't have $125,000 in assets to give you. You are left holding the bag for an accident you did not cause. This is where underinsured motorist coverage, or UIM, rides into the rescue. UIM bridges that terrifying gap. Once the other driver's insurance has paid out its maximum, your UIM coverage kicks in and pays the rest, all the way up to the limit you selected for yourself. This brings us to the single most important piece of advice in this entire section. When you select your coverage limits, you should always aim to have your uninsured and underinsured motorist limits be the exact same as your own bodily injury liability limits. If you choose to protect a random stranger you might hit with $100,000 of coverage, why on earth would you give yourself and your own family any less protection? You are far more likely to be hit by an uninsured or underinsured driver than you are to cause a major accident yourself. Protecting yourself from them is arguably the most important job your auto insurance policy has. So now your medical bills are covered, and you're protected from uninsured drivers. But what about the single biggest piece of the puzzle for most people? What about your car itself? That beautiful, expensive machine sitting in your driveway. What happens when it gets crumpled in a crash? Or stolen from a parking lot? Or smashed by a falling tree? Who pays to fix or replace it then? That's where the two most misunderstood coverages come into play: collision and comprehensive. Let's break them down, because understanding the difference is the key to protecting the thousands of dollars you've invested in your vehicle. Think of it this way: collision coverage is for when your car collides with something. Simple, right? It could be another car, a telephone pole, a guardrail, or even a building. The key factor is that your car is in motion and makes an impact. Comprehensive coverage, on the other hand, is for almost everything else. It's the other than collision policy. Think of it as the coverage for all the weird, unpredictable, non-driving related disasters that can befall your car. Let's make this real. Imagine a guy named Alex. Alex just bought his first car that wasn't a hand-me-down beater. It's a 3-year-old certified pre-owned sedan. It's his pride and joy. He washes it every weekend. One rainy Tuesday night, Alex is driving home. He takes a turn a little too fast. The tires hydroplane on the wet pavement, and the car spins out, slamming sideways into a concrete median. The sound of crunching metal is sickening. Alex is shaken up, but thankfully he's okay. The car, however, is not. The entire passenger side is caved in. This is a classic collision claim. It doesn't matter that no other car was involved. Alex's car collided with an object, and he was at fault. So what happens now? First, Alex calls his insurance company. They open a claim, and this is where the first painful word comes into play: deductible. A deductible is the amount of money you have to pay out of your own pocket for a repair before your insurance company pays a single penny. It's your skin in the game. Let's say Alex chose a $1,000 deductible for his collision coverage. An insurance adjuster comes out to inspect the damage. They determine the repair will cost $8,000. Because Alex has collision coverage, he doesn't have to pay that full amount. He just has to pay his $1,000 deductible directly to the body shop. His insurance company then pays the remaining $7,000. If he didn't have collision coverage, he would be facing an $8,000 bill, or a completely useless car. But what if the damage was worse? What if the adjuster looked at Alex's crumpled car and said the frame is bent, the engine block is cracked, and the repair cost is actually $15,000? Here's where we run into another critical concept: actual cash value, or ACV. The insurance company looks up the market value of Alex's specific make, model, year, and mileage right before the moment of the crash. This is not what Alex paid for it. It's not what a brand new one costs. It's what his used car was worth in its pre-crash condition, factoring in depreciation. Let's say the ACV is $12,000. Since the repair cost of $15,000 is more than the car's value of $12,000, the insurance company will declare the car a total loss. They're not going to pay to fix it. Instead, they will total it out. They'll write Alex a check for the actual cash value, $12,000, minus his $1,000 deductible. So, Alex gets a check for $11,000, and the insurance company takes possession of his wrecked car. This is where so many people get angry and confused. They say, "But I can't buy another car like mine for $11,000. And they might be right. But insurance isn't designed to put you in a better position. It's designed to compensate you for your financial loss, which was the value of your used car. Now, this creates a terrifying problem for many people. Alex financed his car. He still owes the bank $14,000. The insurance company gave him $11,000. He now has no car, but he still has to write a $3,000 check to the bank to pay off a loan for a vehicle that's now a cube of scrap metal. This is called being upside down on your loan, and it's a financial nightmare. The solution? A special, often inexpensive add-on called gap insurance. Gap insurance does exactly what it sounds like. It covers the gap between what your car is worth, the ACV, and what you still owe on it. If Alex had gap insurance, it would have paid that extra $3,000 to the bank, leaving him with a clean slate. If you are financing or leasing a new car, especially with a small down payment, gap insurance isn't a luxury. It's an absolute necessity. Okay, so that's collision. Now let's fast forward 6 months. Alex used his insurance money plus some savings to get another car just like his old one. This time he also bought gap insurance. He's learned his lesson. One summer afternoon, a massive thunderstorm rolls in. Golf ball-sized hail starts pummeling his neighborhood. Alex's car is parked in his driveway. When the storm passes, he goes outside to find his car looks like the surface of the moon, covered in hundreds of dents and a cracked windshield. His heart sinks, but then he remembers, this isn't a collision. He didn't hit anything. This is where comprehensive coverage saves the day. This is a perfect comprehensive claim. It covers damage from things other than a collision. Hail, floods, fire, falling trees, vandalism like someone keying your car, and even theft. If a deer runs out and you hit it, that's also a comprehensive claim, not collision in most states because the animal is considered an unpredictable, moving obstacle. The process is similar. Alex files a claim. The adjuster assesses the damage. Alex pays his comprehensive deductible, which can be different from your collision deductible. Maybe he set it at $500. The insurance company then pays the rest of the repair bill. Because of comprehensive coverage, Alex's car gets fixed without him having to drain his savings. So this brings us to the ultimate question. Do you need these two coverages? If you have a loan or a lease on your car, the answer is simple. You don't have a choice. The bank or leasing company that technically owns your vehicle will absolutely require you to carry both collision and comprehensive coverage to protect their asset. If you drop it, they can repossess the car or buy a policy on your behalf at an insanely high price and bill you for it. But what if you own your car outright? What if you have the title free and clear? Now it's your decision, and it's a calculated risk. You have to ask yourself one question. If my car were totaled tomorrow in a crash that was my fault, or stolen from my driveway, could I afford to repair or replace it with cash, without putting myself in a financial crisis? If your car is an old clunker worth maybe $1,500, and you're paying $600 a year for collision and comprehensive, you're paying a huge percentage of the car's value just for the coverage. A common rule of thumb is that if your annual premium for collision and comprehensive is more than 10% of your car's cash value, it might be time to consider dropping them. You could instead take that $600 a year and put it into a dedicated car replacement savings account. But if your car is worth $10,000, $20,000, or $30,000, and you don't have that kind of cash just sitting around, then dropping these coverages is a massive gamble. You're one slippery road or one hailstorm away from a 5-figure financial catastrophe. Liability coverage protects everyone else from you, but collision and comprehensive, they protect you from you and you from the world. They are the coverages that repair or replace your own expensive machine. We've now covered how to pay for the other person's car, their medical bills, and your own car. But there's a gaping hole in this safety net. We haven't talked about the most important thing of all: your own health. What happens if you are injured in a crash? Who pays for your ambulance ride, your hospital stay, your lost wages? And what happens when the person who hits you breaks the law and has no insurance at all? That's the terrifying scenario we have to prepare for. And it's what we're covering next. This is the scenario that turns a bad day into a financial catastrophe. You followed all the rules. You bought the right insurance to protect other people. But the person who just crashed into you, they didn't. They're driving illegally with no insurance policy to their name. Or maybe they have a policy, but it's the bare minimum. A tiny financial shield that couldn't stop a paper airplane, let alone cover the $100,000 in medical bills you're now facing. In these moments, their liability coverage is either a ghost or a joke. And you're the one left with the wreckage, the injuries, and the bills. So who pays? You do. Or, more specifically, a part of your own insurance policy that you hopefully have designed for this exact nightmare. This is where you become your own hero. This is the story of uninsured and underinsured motorist coverage. Let's start with the most common villain, the uninsured motorist. The statistics are chilling. Across the United States, roughly 1 in every 8 drivers is on the road without insurance. 1 in 8. That means in any group of cars you see at a stoplight, chances are at least one of them has zero ability to pay for the damage they cause. This isn't a rare struck-by-lightning event. It's a daily terrifying reality. This is where uninsured motorist coverage, or steps in. Think of it as a clone of the liability coverage we've been talking about, but instead of you buying it to protect others from you, you're buying it to protect yourself from an uninsured other. It's your insurance company stepping into the shoes of the at-fault driver who has nothing, and paying you what they should have. Like liability, coverage is typically split into 2 parts. First, and most importantly, is uninsured motorist bodily injury, or UMBI. This is your lifeline. Let's imagine you're driving home from work, and someone runs a red light, T-boning your car. You suffer a broken leg and a concussion. The other driver stops, but they have no license, no registration, and certainly no insurance. Your health insurance might cover some of the initial hospital visit, but what about the follow-up surgeries? The physical therapy? The weeks or even months of lost wages because you can't do your job? What about the sheer pain and suffering this has caused you and your family? This is what UMBI is for. It pays for your medical bills, your passengers' medical bills, your lost income, and it can even provide compensation for pain and suffering. It's the coverage that rebuilds your life when someone else shatters it and can't pay the price. The second part is uninsured motorist property damage, or UMPD. This, as the name implies, is for your car. It pays to repair or replace your vehicle when it's damaged by an uninsured driver. Now, it's important to know that UMPD has a complicated relationship with another coverage you might have: collision. Collision coverage pays to fix your car regardless of who is at fault, even if you hit a tree. UMPD only applies when an identified, uninsured driver is at fault. In many states, you can't even buy UMPD if you already have collision coverage. And frankly, collision is a much broader, more comprehensive protection for your vehicle. But if you have an older car and you've decided to skip collision to save money, having UMPD is an absolutely critical, and usually very cheap, way to protect yourself from financial ruin if your car is totaled by someone with no insurance. And what about the most infuriating scenario of all? The hit and run. A driver slams into you, and then speeds off into the night, leaving you with no one to hold accountable. In the eyes of your insurance policy, a hit-and-run driver is an uninsured driver. This is where your coverage becomes your only hope, stepping in to cover your injuries and if you have UMPD, your car damage because the at-fault party is a ghost. So that's the uninsured motorist. But there's another, more subtle villain on the road: the underinsured motorist. This person isn't breaking the law. They have insurance. The problem is, they only have the state-mandated minimum. Let's go back to our examples. Imagine the at-fault driver who hit you has a liability limit of $25,000 for bodily injury. But your injuries are severe. You needed an airlift, emergency surgery, and a long hospital stay. Your total medical bills are $150,000. The other driver's insurance company will write you a check for their policy limit, $25,000. And that's it. They've fulfilled their legal obligation. So where does the other $125,000 come from? Are you supposed to sue the at-fault driver personally? You can try, but if they only had minimum coverage, it's highly unlikely they have $100,000 in assets just sitting around. This is the gap. The terrifying, financially devastating gap between what they owe you and what they can pay you. And this is where underinsured motorist coverage, or saves the day. Coverage activates when the at-fault driver's liability limits are exhausted and are not enough to cover your damages. It stacks on top of what their insurance pays, filling that gap up to the limits you selected for yourself. So, in our example, after you receive the $25,000 from their policy, your own policy would step in to cover the remaining $125,000. Without it, that debt would be yours and yours alone. So, how much of this coverage should you have? The answer is simple and logical. You should have at least as much uninsured and underinsured motorist coverage as you have bodily injury liability coverage. Think about what that means. When you choose your bodily injury liability limits, say $100,000 per person and $300,000 per accident, you are making a statement. You are saying, if I cause a serious accident, I believe the value of someone's medical care, their lost wages, their pain and suffering, could be up to $100,000, and I want to be responsible for that. Now turn that around. If you believe another human being is worth protecting to that level, aren't you and your family worth the exact same level of protection? If your life was upended by a driver who couldn't pay, wouldn't you want that same $100,000 safety net for yourself? Matching your UM/UIM limits to your liability limits is the most logical financial decision you can make. You are simply saying, I want the same protection for my family that I provide for strangers. And the best part? This incredible peace of mind is often shockingly affordable. For most people, adding or increasing UM and UIM coverage costs just a few extra dollars a month. It is, without a doubt, the single greatest bargain in the entire world of auto insurance. We've come to the end of our journey. Over these 10 parts, we've demystified the most confusing part of your auto insurance policy. We started with the simple, terrifying question: what happens if I cause an accident? We learned that liability coverage isn't for you, it's for them. We broke down bodily injury and property damage. We untangled the confusing numbers of split limits and combined single limits. We saw how a simple state minimum policy can be a ticket to financial ruin, and how an umbrella policy can be the ultimate shield for your future. And finally, today we flipped the script. We answered the other terrifying question: what happens if someone else causes an accident and they can't pay? We learned that uninsured and underinsured motorist coverage is the part of your policy you buy for yourself to protect you from the irresponsible and the unprepared. You are no longer a beginner. You are now an informed consumer. You hold the knowledge to protect your family, your assets, and your entire financial future from the single biggest risk most of us face every single day. But knowledge is useless without action. So here is your final task. Sometime today or tomorrow at the latest, I want you to do something that will take you 5 minutes. Find your auto insurance policy. You might call it an ID card, but I mean the full document, the one they email you or mail you. It's called the declarations page. Find it and look for 2 lines: uninsured motorist bodily injury and underinsured motorist bodily injury. Find the numbers next to them. Are they as high as your bodily injury liability limits? Do you even have the coverage at all? If the answer is no, if you see a gap in your own protection, your next step is to call your insurance agent or go online. Get a quote to raise those limits. You will be stunned at how little it costs to buy yourself a fortress of protection. Don't wait for the sirens. Don't wait for the hospital bills. Don't wait until you discover the person who hit you has nothing. The time to act is now, when the stakes are low and the choice is easy. You've put in the work to understand this. Now, go put that knowledge to work and give yourself the peace of mind you deserve. The best insurance isn't just a policy. It's the knowledge to build the right one. And now you have it. Drive safe.